Countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The U.S. stock market heads for a third week of gains, while the U.S. labor market heads for who knows where. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. Whether or not we're going to notch another record high is definitely a question, Romaine.
Absolutely.
So let's take a look at where we're headed into the close here. The S&P is up 0.1%. We're well off the highs. Whether or not we're going to notch that record, TBD. Now, the NASDAQ 100 at another record high as well. That would be the 43rd record high if it is able to close around those levels. And mid-caps were also at a record high, but giving up those gains. The Russell also now negative territory. Now you got the mid-caps up by 0.1%.
Record highs for the S&P 400, Alex Steele.
57 to up today.
All right. We should note, though, that the market price action around the latest jobs report that we got out this morning is indeed actually a bit restrained. Yes, as Alex just noted there with her board, there is a bid to stocks helping extend that record rally. But the conviction and the volume behind that bid, not quite a picture of euphoria. And why would it be? I want to go through a breakdown now of that monthly employment report that we got this morning. It was consequential. 227,000 jobs created in the most recent month. That was relatively in line with estimates. You had a minor uptick in the unemployment rate to 4.2% and a minor drop in the labor force participation rate to 62.5%. In line, in line, in line. While that data may alleviate some of the market's worst fears about a softening economy, it does nothing to really ratify their greatest hopes for a resurgence in economic activity. But the hope now is turning back to the Fed, that the economy is in just that right sweet spot where the Fed will follow through on all of those promised rate cuts, something Tiffany Wilding at PIMCO says is likely, but maybe not at the pace investors had banked on.
We think you likely will get another 25 basis point rate cut. But at the same time, when the Federal Reserve releases its new summary of economic forecast projections, you'll see just a expectation for, a stronger, more resilient economy.
And a lot to parse ahead of that Fed meeting, which is just about a week and a half away, Alex. But we go back to that report that we got this morning, and we kind of forget it's really not just one report.
No, you're right. With the revisions, et cetera, it was much more than just that one. Here was another head scratcher, and this takes a look at the household employment survey. That's that blue line, and the white line is that non-farm payrolls. Now, clearly, they don't track each other perfectly, but what caught everyone a little bit off guard is the big gap between the household and the overall survey. And if you dig in beneath the household, there were a couple worry points. First of all, the labor force shrank by roughly 200,000, and the participation rate fell to 62.5%. That's the lowest rate since May. And overall, we've seen this decline by about 355,000 jobs. So you can call it Goldilocks, or you could say, hey, actually, are the cyclical parts of the economy just maybe not as good as the other parts? And is that a level of concern, Romaine?
Absolutely. Stephanie Roth joins us right now, kicking us off to the close here on this Friday afternoon, chief economist at Wolfe Research, and a jobs report that on the surface, at least on the headline, seems relatively encouraging. When you dive deeper into it, Stephanie, any concern?
I mean, and the biggest thing that would be of concern from the print would be on the unemployment rate. So rising to 4.2, and you mentioned it was modest, but it is still notable. And we have seen a steady trend upwards from 3.5% towards the 4.2%. And, this was a notable uptick, and this would be the thing that is likely to push the Fed to cut in December. So I think that's the biggest takeaway from this report is it largely solidified the fact that we're going to get a cut in December. And if you make some adjustments for the strikes and then also hurricanes, it looks like the print was something like 137,000. And if you make similar adjustments for the prior month, it was about 126,000. So the combination is a labor market that's okay, not overheating, and not really that weak either.
But when we get back to the inflation side of the picture and we take a look at average hourly earnings, 4% on a year-over-year basis, 0.4 on a month-to-month, slightly above what analysts and economists were expecting, Stephanie. Is there concern, or should the Fed have some concern about a potential resurgence in inflation?
I don't think so. Of course, there is always the concern, but I don't think it's going to be related to the wage data that we got today. It was 0.366 when you look at it on an unrounded basis, so it barely rounded up to 0.4. And this is not necessarily seen as the key measure of wage inflation. The employment cost index is a much better measure. Granted, it's a little bit lagged, but the most recent index suggested that it was coming back down towards something that's closer to 3.5%, which is what the Fed's looking for. And by the way, the fact that productivity is picking up, means that the Fed is going to be more comfortable seeing wage inflation running a tiny bit higher. So the fact that productivity is running closer to 2% as opposed to 1.5% last cycle allows the Fed to be a lot more comfortable with a 4% wage inflation as opposed to 3.5%, which they would have thought previously before we saw this pickup in productivity.
That's a really good point. To the distinction of the different sectors, though, I'm wondering if you see any signs of a slowdown in the cyclical parts of the economy. Bloomberg Economics has been saying that and used the household survey as an example of why they do still see that.
I mean, you saw a rebound in manufacturing, so I'm not that worried about it. You have seen the strongest parts of the labor market have been the more defensive things, so that's fair. But I wouldn't say that's the entire story. Generally speaking, the trends have been fairly solid for much of the other sectors, even though healthcare and government have been a big contributor from that perspective. The one thing to flag, retail fell on the print. That's probably tied to the holiday hiring season rather than a real indication about the cyclical parts of the economy or even necessarily the retail environment. People are shifting towards online as opposed to shopping in stores these days.
Okay, fair enough. Although we are getting data out right now that a U.S. October consumer credit rises almost $20 billion month on month, almost double what was expected. So we'll have to wait to get that data on how they're spending and on what they're spending. Okay, so then Stephanie, breakdown for the Fed, because we got a slew of Fed speak today, and the overwhelming conversation seemed to be like we're kind of at the level where we can maybe pause. Do you think that's true? And how long might that pause be?
This is a level where they could start talking about slowing down the pace. This is not necessarily the level that they're likely to want to pause. We think that's closer to 4%. And it seems that the sort of the goal is to get there, not necessarily regardless of the data, but they're going to be a lot more lenient about the data until we get to 4%. And then it's going to be a real question about how much more do they want to cut, if they want to cut further at all. So we do think that there'll be a slower pace to that 4%, and then it's going to be a real question of how much more do they want to cut. So base case is they'll cut in the December and a couple times next year to that 4%, and then it's going to be on the data to prove whether they should continue cutting or if they can wait a little while, and also see how things are playing out from a fiscal perspective.
Well, let's talk about the fiscal perspective here, and I know there's still a lot of big hypotheticals surrounding that, but a lot of people making hay over debt levels and, more importantly, deficit levels and its relationship to GDP, some of the highest levels that we've had in decades. And I am curious as to when the Fed could even start to factor that in. Do they have to basically wait for it all to happen before they factor that in?
I mean, Chair Powell has said that a couple of times that they're not making any forecasts about fiscal at this point. I would imagine they're gonna not take it into account until at some point in the middle part of next year, until it becomes more clear what the plan is going to be. The thing that's most relevant, though, is most likely the fiscal package won't be actually stimulative for the economy in a big way. The real question is about the tariffs. So from a perspective, even though the deficits are quite high, there's very likely to be a big fiscal impulse as a result of any package that's likely to get done. Yeah. Extending TCJA is really just expensive, but it's a continuation of current policy. The question is how they handle tariffs. That's a tough one. So basically our assumption is that they'll probably pause for an extended period of time, see how it plays out on the economy. Because it's stagflationary in our view, we're expecting that they'll ultimately have to cut another couple of times after a couple of quarters of waiting it out.
All right, Stephanie, great to have you. Stephanie Roth, chief economist over at Wolfe Research, helping us break down that employment report that we got earlier this morning. When we come back after the break, we're going to break down a slew of changes in the C-suite. CEOs are, well, being tossed out of their jobs at a record pace this year. A conversation up ahead with management consultant Davia Temin about why it's happening and, more importantly, what the trajectory is for 2025.
All right, also coming up, Opentable dishing out the data on diners' biggest trends this year and what to expect next year. A conversation with the company's CEO, Debby Soo. All that and more coming up. This is The Close on Bloomberg.
Equities are going up over 20%, like that's more exciting. So if you said, I could take risk in my portfolio. Do I need long end interest rates, which is obviously a long durated asset, or would I buy equities for my long duration risk? Like, I'll take equities all day with an economy that's growing, an operating leverage machine called the S&P 500. I would take that, and then I just clip loads of yield in the front of the belly of the yield curve.
That was Rick Reeder, CIO of Global Fixed Income over at BlackRock, on Bloomberg earlier today, on why he chooses equities over fixed income for that duration risk in his portfolio. So joining us now for more is Tracy Chen, portfolio manager at Brandywine and Global. What do you think? Just clip some coupon in the belly and then buy equities?
I think the U.S. fixed income is definitely in a very interesting stage right now because the coupon does look very attractive. But I think Treasury market is now pretty much trading in a range. So if you look at year to date, the range was for the 10-year was between 3.6 to 4.7. And I think next year the range could be slightly shift up, probably between 4 and 4.75. It's really hard to say. Let's see what Trump's policy looks like, and also how resilient the growth will be and how sticky the inflation will be next year. But I think if the U.S. exceptionalism continues and sustains, I think the Treasury market will be still in a range-bound market. And also, it really depends on how the inflation will look like next year.
Well, what do you think? Because when we look at, say, what's happening in D.C., you have tariffs and you have immigration on the downside, then you have sort of tax reform and deregulation on the positive side. And the sequencing can really then affect inflation and growth. What are you guys modeling?
Yeah, I think we look at it all depends on the composition of the policy and the magnitude of the policy, how much tariff he's really going to impose, and also the sequencing of all those policies. So if you look at the tariff, it will be higher, but how much higher? Will he use the tariff as kind of a negotiation tool, or he will just impose tariff on day one? And then the massive deportation is easy to say, but hard to implement. But these two should be easier to do than lower tax rate and deregulation, because the latter two will need some congressional approval.
I am curious, though, Tracy, for investors, like, what's going to be easier for them to parse? I think I can kind of understand what the president-elect he'll be able to accomplish more easily than others. But investors, of course, you look at things like immigration, tariffs, it's still kind of esoteric, and it's not really clear how that's going to feed through into the economy and, more importantly, asset prices. When you look at the fiscal situation and some of the changes they want to make there, on tax policy as well there, do you see maybe a little bit more certainty in being able to model those outcomes?
It's really hard to model, to be honest. I think on the fiscal side, it also depends on how the DOGE proposal will be implemented. I think there were so many oppositions to a fiscal cut. If you look at Europe, things are not easy there, like France and Germany. It's almost universal. It's so difficult to cut fiscal spending. I think U.S. is not exceptional there either. So I give them the credit of doubt. But at this stage, I think fiscal is still the biggest problem. The bond vigilante is still right out there to closely monitor the situation. So, but to be honest, the government is the most levered sector. So as credit investors, we don't like leverage. So we will be very cautious on investing in the government bond market right now. And it's so correlated across the US and Europe.
Well, I'm curious, but how much pushback do you think these so-called bond vigilantes can really do, Tracy? We look at the price action in the Treasury market. It's kind of been range-bound now for the last few weeks. And it's anyone's guess whether we see a shoot up higher in the benchmark to 5%, or maybe it goes down closer to 4%. At the end of the day, as you sort of try to figure out whether you buy into the benchmark, whether you buy into duration, or whether you stay short, or whether you don't do anything at all, what is going to be the determinant of that decision?
I think the yield is definitely looking more attractive comparing to 2020 and 2021. So it's hard to be short here. So we are kind of neutral because it's all trading in a range. So it's hard to have a high conviction, but the yield is very attractive. But there are other ways to achieve even better yield, like the credit market or agency MBS market. You can get extra carry, and especially when the Treasury trading in a range, the agency MBS thrive on the range bond Treasury market.
How much credit risk, Tracy, do you want to be taking on right now?
Yes, yeah. Definitely. So if you, we like both corporate credit and also securitized credit. Corporate credit, the spread has been tightening drastically this year. But if you look at all-in yield, they are still very attractive. So why not take short duration, higher yielding credit asset or either floating rate or fixed rate. But again, you can get easily like 6% to high single digit yield without taking too much credit risk.
All right, Tracy Chen, portfolio manager over at Brandywine. That 10-year yield camped out right around 4.4 and change here on this Friday afternoon. Meanwhile, equities continue to get a bid. In fact, if you look at the biggest movers in the S&P, a lot of stuff in the discretionary space, including Ulta Beauty. A beautiful day for those shares, having their best days since August as a cosmetics and health retailer beats key metrics in its most recent earnings report. We're going to have a deeper dive into that when we come back in our Top Call segment right here on The Close on Bloomberg. All right, let's get a view from the sell side. It's our top calls, big movers on the back of analyst recommendations. And we're going to start off today with Asana. This is the work management software platform having a phenomenal day after KeyBank upgraded the stock to sector weight on the back of a solid but not exceptional third quarter earnings report. The analyst seeing encouraging signs of stabilization driven by demand for Asana's AI Studio product and expects the company's financials to improve. Those shares having their biggest one-day gain on record. Next up, Dollar General. A double upgrade to buy from underperform. This over at Bank of America. The analyst highlighting the discount retailers' improved inventory position and better in-stock levels. He also expects store closures by competitors like Family Dollar, CVS, and Walgreens to offset some of the pressure on Dollar General from Walmart. Those shares up 3.5%. And let's take a look at Peloton. Remember Peloton? Those shares pedaling higher after UBS upgraded the stock to hold from sale and quadrupled its price target to $10. UBS says while Peloton's growth outlook remains elusive, there should be EBITDA support from additional cost cuts. Peloton, which just a year ago had 5 sell ratings, now has just 1. And that's over at BNP Paribas. The shares up 4% on the day, and those are some of our top calls. We do want to take a look at another company, one company whose shares are getting into shape, and that's Ulta Beauty. The retailer having its best days since August after a stellar third quarter report yesterday. Olivia Tong joins us right now. She's managing director and senior analyst covering consumer brands at Raymond James. She's got an outperform and a $4.95 price target on the stock. All right, when I look at Ulta, Olivia, and I look at the way that you and your team are valuing this, is this kind of about the potential growth story that we're going to see out of Ulta going forward, or is this more about the run-up that we've had to where we are today?
Thanks, Romaine. Thanks for having me. It's more about the go forward. Q2 was quite challenging for them, and then Q3 got a lot better. Comps inflected positive in Q3, which we think bodes quite well for holiday. Obviously, Q4 very important for retailers, and particularly in beauty, and that usually accounts for over 30% of sales. So we think that they had some missteps in Q2. They corrected a lot of them quite quickly in Q3. And importantly, they didn't really touch the Q4 outlook. So we think that that is, prudent in this environment where we do have 5 fewer shopping days between Thanksgiving and Christmas this year. And, with a shakier macro backdrop right now, we think that that bodes well. The path forward after some more effective promotion and some newness coming looks pretty good for Ulta.
Well, that's one thing I'm interested about is kind of the catch up that this stock has to do when you consider its underperformance relative to some of its peers and other places in the discretionary space. What is kind of the thing that separates Ulta for a consumer that has a lot of options? You can buy a lot of this stuff at a department store, or obviously a place like Sephora or some of the other dedicated stores that sell beauty products.
Great. Yeah, I think ultimately we're pretty bullish on beauty longer term. We think that the addressable market has increased. You know, consumers are getting into the category at a younger age. And at the end of the day, this is a fun category to shop. People like to do it in person. They like to touch, feel, smell, try things on. So that's something that Ulta does obviously provide. They also have a lot of technology tools with respect to trying on virtually and also buying online, pick up in stores, so that you can you have a lot of different options, and they're trying to meet the consumer where they are, whether it's buying online or whether it's in store. So we think that, you know, this is one way that they can differentiate themselves. You're right that competition has gotten more challenging. There's been more retailers getting into beauty. Sephora is opening, has opened quite a few doors in Kohl's, over 1,000 doors at this point. But the majority of those are now done. So the incremental headwind that we see from competition seems to be subsiding.
I want to get your take on how beauty is going to stack up when it comes to, say, tariffs and inventory and how they manage that. We're starting to hear on different companies' conference calls that they're thinking about what to do if those tariffs come into play.
Yeah, it's a great question. And obviously, there's a lot of discussion still going on with respect to China manufacturing. Of course, what we've heard with respect to Canada and Mexico, too. So a lot of different things that companies and we're all trying to solve for. You know, within beauty, there's not a ton of direct manufacturing exposure there. Certain companies have it. But we think that one area with respect to beauty is that pricing typically is a little bit easier in these categories, you know, vanity categories. You do see a little bit, the consumer being a little bit more amenable to pricing. So our suspicion is that if tariffs came into play, that you would start to see some companies potentially address their prices and see some price increases there.
Interesting. And you feel like then that would be acceptable to the consumer? Like they could pass it on for the most part?
Within reason. You know, obviously, if it comes with innovation, then there's a case for the pricing. And then, of course, if everybody is getting hit by the same amount of tariffs, then, of course, it wouldn't be surprising that many of them try to pass it on to the end consumer.
True. It's like a sector. It's not specifically an Ulta Beauty situation. Olivia, thanks a lot. Really appreciate it. Olivia Tong joining us from Raymond James. I want to go back to that breaking news at the top of the hour that U.S. consumer borrowing remained increased by almost $20 billion month on month in October. The estimate was for $10 billion, and revolving debt, like credit cards and stuff, surged $15.7 billion.
Yeah, well, this is where now we're going to get into this debate as to whether this is a healthy sign of consumer spending or an omen of what's to come here.
It's always both, right?
Well, but what I will point out is go back and look at the data that we had in holiday season 2023, holiday season 2022. More people were making further purchases using cash rather than credit. There's a big difference now this time of year. Now, again, whether folks can actually afford to pay that down, we're going to find out over the next few months and years. Well,
we heard also from the New York Fed in November that 3.5% of outstanding consumer debt was in delinquency in some capacity in the third quarter. Anyway, a wild week for the C-suite. We'll break it down. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. We're losing a little bit of steam. You're looking at an S&P. It's still up by just 0.1%, but mid-cap's kind of rolling over. We could end a little bit mixed.
A little bit mixed here, certainly on the Friday. On a weekly basis, the rally does continue to carry on. It's been relatively strong, but I was actually taking a look earlier at that rally, and it is pretty much all the Mag 7 this week.
Yeah, I mean, Mag 7 is still at a record.
You strip them out, and we're basically in the red.
Yeah, I mean, you have Meta, you have Amazon, Apple, all sitting at record highs today. What's also interesting this week, if we take a look at themes, is just how much C-suite shakeups there was on the CEO and CFO level, and in so many different sectors also. Yeah, it's been relentless. And at first I thought to myself, well, it's kind of the end of the year. Companies obviously rethink a lot of things, but you can see the numbers here. I mean, we're kind of approaching levels that are historically well above averages. And it kind of makes you, and that's just the CEOs. Yeah. I mean, don't forget, there are all the CFO changes, CTOs, and all these other C-suite changes at so many companies, Stellantis, Etsy, Intel, Bumble, and a bunch of more that we're forgetting. And we still got, what, three and a half weeks left in the year? Yeah, and it raises the question, why? Why now? And if there's something more we need to read into this. So we want to delve into this a little bit more with Davia Temin, president, founder, and CEO of Temin Co. The firm specializes in corporate crisis and risk management. Davia, if we try and connect all the dots through the CEO and CFO changes that we've seen. What is your takeaway?
Takeaway is that we're in a time of unprecedented disruption. Technological disruption. What is AI going to do to my company? Everybody's being said you'd better pay attention to what AI is doing. And how do you grow value from that? There's disruption, obviously, geopolitically, disruption ecologically, disruption all across the board. So you almost have to be superhuman to be a CEO, that one person who is in charge of all of these different responses. And those are hard to find.
Yeah, and what I also find interesting, too, is that we've seen, at least in the case of Intel as well as Stellantis, like the CEOs leaving before there's a replacement. And then in their place are like multiple CEOs that are all magically going to work together. That also feels somewhat unusual. Can you give me your perspective on that?
Well, again, it reflects the mosaic of what everybody's got to be facing. And there are very few people who can be facing all of these kinds of challenges and do great on every single one. Most importantly, what boards, what investors are interested in is creating value for them. That's, of course, number one. And what consumers are interested in is creating something that's of value to them. So, but the game is changing as we speak. You don't just have to be like humanly agile and fluid and resilient. You have to be superhumanly such.
Well, I want to talk about kind of the selection and kind of what these folks are facing, particularly headed into 2025, at least here in the U.S. with the change in administration. I'm just going to cherry pick one name, Brian Nichols, who, of course, went from Chipotle to Starbucks and was kind of lauded at the time as basically being kind of really one of the best CEOs, if not the best active CEOs out there. He's taken over a company like Starbucks, which had a lot of challenges just selling products. He's heading into, a lot of DEI controversy that could come back against him. He's got union issues. He's got issues in China. Of all the jobs to take, this one was probably way more complicated than anyone that he's taken prior to that. And I know you probably don't know the answer, but I'm going to ask you anyway. Why? Why take it? Is it just money or what?
No, I think that leaders want to lead, and leaders want to lead under challenging circumstances. It's just that it is conceivable that they discount just how hard it's going to be, and that maybe they're not going to be able to do everything that the folks who hired him, that their board wants them to do, and that they have some limitations as well. We don't know. I don't know what his psychology is, what his psychological bents are. But, to want to grow and to go to the top of the mountain and get it and bring back value, of course he wants to do this. Can he is another question.
Yeah, and that's the big question, as balancing all of these different and competing interests. And of course, you're also dealing with employees who have demands, customers who have demands as well. As we start to see more of these vacancies come up, and as Alex kind of pointed out, I mean, we're seeing some departures where the replacement either hasn't been named or even they haven't even started looking. And it raises a question that if you see a vacancy like that, if you're a potential CEO and you're on the market, you see a vacancy like that, is that tantalizing to you, or do you maybe think to yourself, wait a minute, I don't want any part of that. If they can't figure out a proper transition, why would I want to be there?
Well, I think there's probably somewhere in the middle where they think, I mean, first of all, you're not going to be running toward it necessarily, but you are going to be thinking, I could have managed this succession better. I know how to manage. I have some skills that they really need. And here's where my skills are congruent with what I can see they need. And if that's really true, then they are the right person. Well, so it's conceivable.
But Davia, what I also find confusing is like the boards are also there, right? Like the CEO just can't do their own thing. Like they have to report to a board, and the board approves what the CEO also wants to do. So are we going to see a lot of board replacements and activists come into these kind of companies also? Or what do you think of that?
Yeah, you probably are going to see more activists, but it used to be that the mantra for boards was noses in, thumbs out. Meaning you ask a lot of questions, you make sure you're comfortable with everything, but then you let the leaders lead, you let the management lead. And you don't take on that responsibility, even if you're a CEO of your own right in another company. These days, what I certainly find is that when trouble comes along, and it does come along far more frequently than it ever did before, boards forget this, and they don't just put their noses in. They they roll up their sleeves and they put their whole arms in to try to fix the situation. Boards may or may not have the capability to do that, and you've got a lot of expectations that are on one person, a CEO and his or her management team. So, there probably need to be far more realistic expectations of what the trouble's going to be at the outset of a CEO being hired. And I'm not sure that always happens.
Yeah, and that's what's so interesting, like with Boeing. They sort of chose a steady route, nothing crazy, just, steady as she goes and nothing really transformational. I wonder if we're going to keep seeing something along those lines. So crystal ball it for me. Is 2025 going to be better for CEOs than 2024?
No. I don't think it is going to be better because especially with technology, especially with AI, then quantum coming online, everything has to be rethought on what the value proposition is going to be. All of the various constituencies, how you deal with them, that's all being rethought as we're speaking right now. And we see that from Robbie Starbucks. We see that from all the companies that are changing one way or another. That pressure, I don't think, and one more thing, you've got a president who has chosen a cabinet that are disruptors.
Yeah.
So the disruptors disrupt.
Absolutely. Davia, this is a great conversation and obviously something that a lot of us are paying a lot of close attention to. It'll be interesting to see how some of these positions get filled and, more importantly, with who. Davia Temin, president and founder and CEO of the management consultancy Temin and Company. I do want to see kind of the final tallies on this as we get towards the end of the year. And also, too, really, it's kind of that second tier, too, that kind of struck me. Like, even with the Etsy announcement, was it yesterday, earlier this week? I mean, it was kind of almost wholesale changes in a lot of those key C-suite positions. And maybe this is the CEO deciding, okay, here's what I need to really sort of carry out my vision for next year. But I don't know if that's the safest way to do it.
Well, I also find it interesting, too, what she was saying about how it's because we're in a world of so much disruption. I hadn't thought of it from that lens. I thought of it more of like a company execution-specific issue, not necessarily that. But if you tie in AI, it's right. Like, if you don't handle that disruption well and you can't manage that into your business, you might get some real problems with that.
Absolutely. All right, a lot more coming up here on the program. We're going to take a look at some of the big movers on the day, including Qorvo and Qualcomm taking a hit on the news that Apple will debut an in-house modem chip. It's our stock of the hour. It's coming up next, right here on The Close. Welcome back. Time now for our stock of the hour, and keeping a close eye right now on shares of Qualcomm as well as shares of Qorvo, each down fractionally on the day following Apple's announcement that it will debut an in-house modem chip next spring. Apple is planning to use its own modem chips, which will reduce its reliance on external suppliers, like those two names you see on the board. Abigail Doolittle joins us right now to talk us through this. And, we've kind of known this was coming. Mark Gurman has been reporting on this, I feel like, for years. But it finally seems like this is finally coming to fruition. Is the market reaction that we're seeing on Qualcomm and Qorvo, is that warranted?
It's priced in, essentially. I mean, at the lows, they were down 2 or 3%, but now down less than 1%. I can actually remember breaking this news from a stock reaction point in 2018 or 2019. Wow. And at that time, there were big reactions. Yeah. Now, they were supposed to have this modem ready for market by 2021, but lots and lots of delays. It's interesting in Mark Gurman's piece, he talks about the speculation as to why they're actually doing this, because they've spent billions of dollars. It's taken a lot of time. This first generation, that one that's going to come out, that's called Sinope, Sinope. In any case,
if you say so.
Yeah, I'm not sure if that's the pronunciation.
That's the code name, by the way.
That a code for a little bit slower than Qualcomm's version. So, and they're testing it on the lower end phones for that reason. Then they have another one that I'm not going to attempt to produce coming out in 2026, and then Prometheus in 2027. And at that point, that's going to be a higher end one that will match Qualcomm. They of course were in a legal battle that they lost. So Mark Gurman's piece speculates that maybe that's some of the impetus for spending so much time and so much money on basically hardware, something that's not too all that proprietary. But in terms of the stock reaction, especially for Qualcomm, largely priced in. Qorvo maybe a little bit less so. One stock that's also down and interesting is because they, of course, created this chip, which is basically a modem. A modem connects the cell phone to the tower, to the internet, and to the Wi-Fi, is Taiwan Semiconductor. They are actually going to be producing it. You would think that stock's up. The last time I looked, the ADR down about 2%. So I think, a lot of this basically priced in and
well, I think it also is a question of how successful Qualcomm has been / will be at diverting some of its revenue. If it gets more than 20% of its revenue from the iPhone, right? They've known that, as you point out, for years. So, how successful are they at migrating to different sources of revenue?
I think that will be something to be seen for sure. In terms of, I don't think that I've heard too much of their play into AI, but that would seem as though potentially that would be like a new area for them to go into. But Qorvo, again, is the one where I think it's a little bit less priced in, so that could be a one to keep an eye on. All
right, Abigail, thanks a lot. Stocks of the hour. We appreciate that. Something else to pay attention to here. Meta is at a record high, Romaine, and you have to look at the ruling with TikTok. The court upholding the ban on TikTok. It should go into effect on January 19th. Clearly, there's an execution problem here, and there is how do you actually enforce all of this? But nonetheless, stocks are moving.
Yeah, you're also seeing Snap higher by about 3%, Pinterest up as well. A lot of interesting to see whether this was a January 19th deadline, which we should point out is the day before the inauguration of the new president, who has said that he's maybe amenable to letting TikTok survive here.
And you have to look at the investors in TikTok and ByteDance, for example. A lot of rich VC guys in the United States. Anyway, we're counting down to the closing bell. 15 minutes delay. We're losing steam. We'll get the technical update for you. This is The Close on Bloomberg.
The fact that productivity is picking up means that the Fed is going to be more comfortable seeing wage inflation running a tiny bit higher. So the fact that productivity is running closer to 2% as opposed to 1.5% last cycle allows the Fed to be a lot more comfortable with the 4% wage inflation as opposed to 3.5%, which they would have thought previously before we saw this pickup in productivity.
Stephanie Roth there kicking us off to the close just about 50 minutes ago. A conversation that we started the show off with about that jobs report that we got this morning. It wasn't bad.
Nope.
But there was some bad in it. And I guess you put it all together. The net effect of it is what? We get rate cuts and whoopee, stocks go up?
Yeah, pretty much. Okay. I mean, it's just that Goldilocks scenario. The question is, how long I feel like I've been saying this for weeks. How long does that actually last? And how do you protect yourself against a potential downfall when you have record high after record high of the S&P? Yeah, I mean, look at this, 6,088 and change right now. And it's that incremental move higher here. And of course, this week and today, certainly powered by the Mag 7. But it gets to the idea here that if you don't care too much about valuations, or you're not at least obsessing over it here, then it does become a momentum market. And, some folks, they have no option but to chase that momentum. And that's the FOMO retail trade. Yeah. It's also mechanical fund buying. So if you get both at the same time, higher prices. I am curious as to the mid-cap underperformance, because you have that record high in the S&P and the Russell's outperforming, and then where are the mid-caps?
And I thought, though, that if you believe that rates are coming down, I would think that would feed into
sweet spot.
The mid-cap story, right? But I guess for today, most people are just gravitating, of course, to the big cash generators. Once again, Alex. That is, of course, been the story of the day and on the week as we start to talk about how these market moves sustain themselves into next week and beyond. Let's get some insights out of John Kolovos. He's the chief technical strategist at Macro Risk Advisors. What are the charts telling us, John? I mean, can I bank on additional gains, meaningful gains out of this market?
Thanks for having me. I would say on a short-term basis, yes. Seasonality trumps sentiment right now. I do expect that it will still have robust gains into the end of the year. The S&P, thinking 6,150, 6,200 by the end of the year. And then looking into next year, given how strong trends are, given how robust breadth is, given how cross-asset implied volatility levels have come down, I think you can continue to see the market push higher, the S&P. And my targets for next year on the lower end are around 6,600. And on the high end, 7,700.
Wow. Okay. 6,600 certainly relatively in line with some of the estimates we've heard from other folks on Wall Street. The 7,700 certainly out of line. But it raises a question in all seriousness, though. I was just looking visually at the S&P chart on a year basis, so 2024, I looked at the one from 2023, so on and so on and so on. It was hard to find a chart that looked like 2024. I mean, this has basically been a straight shot up. I mean, we had a little bit of that downturn, I think, what was it, like late July, early August. But for the most part, this has been a straight shot up, holding above all those key moving averages, both on the short and the long term here. Is there any historical precedence to say that this repeats itself for another year?
Sure. Yeah. So the 1990s really come to mind. You got to remember that in the 90s, what we saw were 4 consecutive years of the market being up 20% or more. And we almost got 5. 1999 was only up 19.5%. That was a robust. I mean, that was like almost a very steady uptrend. I don't believe the market even touched its 200-day moving average for a couple of years at that time. So, short answer is yes. I think it can continue to do that, and reminds me a lot of what happened then.
John, that gives me to big tech because we've seen big tech really outperform. It's the story of the Mag 7 this week at a record high. If you look at the Mag 7 index, is that tapped out?
No, actually, I think it's what's quite interesting with the Mag 7 index is that it's just breaking out of another consolidation pattern. So it basically has been pausing for the last couple of months, basically since the summer. Basically, when NVIDIA peaked, Mag 7 kind of just stalled out and just took the backseat to, say, financials taking leadership. So I think they're about ready to continue to push up higher. And that's actually a very important component to my call for next year, is that these key bellwethers are trending higher and they actually look fine. I mean, we can complain about a few of them, but by and large, most of these Mag 7 charts are intact and actually count higher. Yeah.
John, does that spread? I mean, the Russell it made a new high, the end of November, for example, but the Russell has not been able to keep pace over the last couple weeks. Mid-caps keep making record highs, but still. So does that bullish call spread out?
I think so, and that's generally what part of my call for next year also is that we see a general broadening out of equity participation. So some of the studies that I've shown recently, reports have shown, like the value line index, when that rate of change exceeds 20% or so, that continues to push up higher. Why is value line index important? Because that represents the average stock. So the studies I've done say that, yeah, breadth should continue into next year. The market should continue to push up higher to next year. But think about this. If like the Russell is just making new highs, it's testing it, right? The S&P made its all-time high a year ago. There's about 40% of the equity market, in my estimation, that is just about getting their sea legs. They're just starting the party. Mm-hmm. It's uncommon, really, to see breadth expand this far into a bull market, but it's happening nonetheless. And I think with the Fed earlier on, by hiking rates as aggressively as they did, they really put the kibosh on these smaller domestically focused companies. Now you remove that, it's kind of like a coiled spring, I should say, sorry, and that can push them higher. And so I think that's what's going to happen next year.
So that's the stock market. I'm curious, John, what your view is right now of the direction for benchmark interest rates. There's been a lot of speculation about the 10-year yield, whether it's headed towards 5 or maybe back down to 4. Anything you're seeing in those charts that would give us a bit more clarity on directionality?
Yeah, absolutely. So big picture, I'm a bear for bonds, right? I think it's a structural bull market for yields, and they're going to go higher over time. What does that mean? Yeah, we'll get to 5, we'll get to 6, maybe we'll get to 7% over the next couple of years. But shorter term, what's more important for right now in the market, I get the sense that we're probably entering into more of a range, if you will, 475-ish being the top end of it, the lower end being around 390. But my guess for next year, my best guess reading the wiggles for next year, is that we'll break that 475. 530 seems to be about where I think the 10-year gets to next year.
All right, John, we'll all keep an eye on those wiggles. John and Kolovos, have a wonderful weekend. Chief Technical Strategist at Macro Risk Advisors, helping us count down to these closing bells on this Friday afternoon. We're just about 3 minutes away, Alex, and stocks are holding on to some of those gains. It looks like the S&P 500. Can I do it?
Do it.
6,090 and change, which would be its 56th record high?
7th.
Okay. Oh, gosh, I failed. All right.
And what about the NASDAQ 100?
This is why we keep you around, Alex.
Really, the only reason.
Because we'd be completely lost. But still, pretty meaningful gains on the week. The S&P only up 1% on the week, but you have the NASDAQ up about 3%. And, of course, a lot of that fueled by the Mag 7.
NASDAQ 100, another record high, which would be the 43rd record high for the NASDAQ 100 so far this year as well. So, you know. Big tech leading the way.
We are going to keep counting those record highs, and we are going to keep counting you down to the closing bell here on this Friday afternoon. A full breakdown of all our coverage. It starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele. We're taking you through that closing bell with a global simulcast that starts right now. We're joined in the TV studio by Scarlett Fu, as always, Tim Stenovic in the radio booth, Nora Melinda filling in for Carol Massar today as we welcome our audiences across all of our Bloomberg platforms. Here on what looks to be another record-setting day, Tim Stenovic, 3 straight weeks of gains for the S&P 500, and it looks like it's going to be, I'm told, a 57th record high.
Yeah, I heard that somewhere as well. 57th record high. I'm looking at other record highs, too, including Meta Platforms. We can't stop talking about TikTok over here. I'm not a big TikToker.
Yeah.
Romaine, are you a big TikToker?
I thought we renamed that to Bloomberg Originals.
That's such an inside joke.
Nice inside joke. We did used to have a TikTok here. That was
the other TikTok. Oh, I'm sorry.
Yeah, the other TikTok. The one that could be, January 19th. No longer be allowed here?
No, we don't do TikTok here.
Yeah. See, I'm using it.
Nora does.
I do. Thank you, Alex.
Nora's the one who's been telling me about TikTok, guys, to be fair.
I know all the deets.
All right. What are the deets? Are you actually going to be able to use TikTok on January 20th?
I surely hope so.
Okay. All right.
I have a TikTok account. I haven't checked it in a while, but, that's for another day. What's interesting about this market high is that it's not accompanied by a whole lot of volume. It just feels like a lot of people are sleeping until the new year, until January 20th, honestly, until we get some new catalysts, because until then, it's a whole lot of uncertainty.
Yes, it is a lot of uncertainty, which is interesting, though, why you still see the Russell 2000 doing well, even though the mid-caps have not. So that's interesting to take into effect there.
All right, let's walk you through the numbers here, because it was an interesting week for the markets. And to Scarlett's point, too, we should point out volume roughly about 10 to 15% below where it would normally be over the past 20 days here. A Dow Jones Industrial Average right across the screen there, down more than 100 points, or roughly about 0.3%. It's also lower on the week as well by 0.6%. The S&P 500, 6,089 or 990 as these numbers, of course, take time to settle, but that's going to be good enough for a record high, up 15 points or about 0.2% on the day, and about 1% roughly over the 5-day stretch. The Nasdaq Composite higher by 159 points or 0.8%, a 3% gain on the week. But the Russell 2000 kind of sitting this one out. Green on the screen for the day, 0.5%, but on a weekly basis, it's down 1.3%.
All right, well, let's take a deeper dive into the S&P 500. We did have 205 stocks move higher today, 295 stocks move lower, so showing that those stocks that did advance were those larger market cap names.
Yeah, and the larger market cap names are also the growthier parts of the market as well. Look at the IMAP here, and it shows you that consumer discretionary up 2.4%, communication services gaining 1.4%, and tech just barely positive, but it is still a gain of 0.1%. Growthy parts of the market gaining ground. The weak parts of the market, energy, utilities, and healthcare.
All right, let's take a look at some of the stocks that did move higher on the day today. Back to this idea of TikTok being banned. Bad news for TikTok, good news for Meta Platforms. Meta Platforms closing at a new record higher today by more than 2%. Shares of Meta surging after that U.S. Court of Appeals in Washington refused to block that law requiring TikTok's China-based owner to sell the app or face a U.S. ban. 2.4% to the upside today, closing at $623.77. Look, the next stop is the Supreme Court. We'll see what happens if the Supreme Court does indeed hear this. We also saw shares of Alphabet, Snap, and Pinterest rise on this news. Let's talk Lululemon, because shares posted their best one-day gain in 6 years, higher by 16% today. This after the company edged up its full-year outlook. Strong sales overseas, a sign that the company is spending off those upstart competitors, navigating slower growth in consumer spending. And finally, shares of Asana having their best day ever today. Shares just surging. This after the company provide third quarter revenue that beat estimates, a sign that the business is stabilizing, according to analysts. Look at that, up by 43.5%.
Can I throw an honorable mention, too? I thought the rebound that we saw in DocuSign today was pretty phenomenal. I think it closed higher by more than 20% on the day, Tim.
I only get 3, Romaine.
Oh,
so
I know.
I appreciate.
But you know, Carol usually the
He's doing what he can.
like 6 or
Yeah.
so,
I'm a rule follower here, guys.
I know. I like that.
I get 3.
Same, Tim. All right, Nora, what do you got?
Well, so let's look at some of the names in the red here. I'm keeping an eye on Cooper Companies. Now, this is actually the maker of contact lenses, but they also do some different providing sources for different gynecologists and medical companies here as well. But we're seeing the shares down about 4.3% at the close, and this is coming after it reported a 2025 forecast that disappointed expectations. But I did want to keep an eye also on some of those healthcare names that we saw falling. Of course, we know United Healthcare. We did see United Health Group, ticker UNH, falling, led a decline for many of these health insurance companies after, of course, that news that we had when they had their investor day, and as well as the shooting of the head of their insurance department. But those are some of the names that I'm looking at, as well as DraftKings. I mean, this is also a company that I'm keeping an eye on because of its Flutter. Flutter, which is the parent company, actually fell after senators are seeking an FTC probe. So something to keep an eye on in this space.
All right, I'm taking a look. Yeah.
I just want to point out to it, just another decliner. We kind of missed this. AMD took a big leg down towards the close here. There was a report out on Business Insider about Amazon expressing some concerns about not enough demand for the company's latest AI chips. And remember, it kind of has that partnership with AMD, and that's the feed through there. Those shares ended the day down 2%.
You have 2 honorable mentions?
Yeah, 2 honorable mentions.
That's something. All right, bless you, Charlotte. Bless you again. I'm taking a look at the bond market here because we had sort of a rally pretty much the second those the jobs data number came out at 8:30. Obviously, it was centered in the front end. You get the 2-year yield down by 5 basis points. I do want to point out that we got a lot of Fed speak today as well. Then the blackout period starts, and it was a little bit mixed. Like Michelle Bowman talking about lower rates cautiously and gradually. You also had Beth Hammock saying the same thing. They're near or at a point where it makes sense to slow down those rate cuts. And Mary Daly saying she also believes in gradualism. Goolsbee, a different story, a little bit more dovish, but it was an interesting read through today.
I don't understand though how this sort of all fits in though, right? Because if you look at what we saw in the market and the repricing in a lot of the swaps market here, everyone still thinks we're getting a ton of rate cuts now and through 2025.
I think they're just airing all the possibilities as we wait for more data when it comes down to it, right? Next week you have CPI on Wednesday and then PPI on Thursday. That'll give a little bit more direction as to what the Fed does on December 18th. And then, of course, it's the outlook for rate cuts and unemployment for 2025 that's really going to set the tone.
I guess I'm surprised a lot of people aren't talking more about the unknowns that you have with the incoming administration. If he does go through with the tariffs that he's announced, if he does end up going through with deporting millions of Americans and what potentially inflationary aspects that could bring, what that does to rates.
But I feel like isn't this kind of a repeat, though, of what we saw in 2016? I mean, people talk about that Trump rally, but they kind of forget most of that rally occurred before he was ever actually inaugurated. It was sort of like, okay, you know, we're euphoric, we all bake it in right now. And then, of course, once you started to see those policies, that's when you saw maybe a little bit of a consolidation in the market.
Yeah, remember all the volatility around the implementation of those China tariffs?
Yeah, absolutely.
But those are there now, and they're still there. So.
Yeah, absolutely.
Okay,
are you stocking up? You know, people are hoarding things, Tim, now.
I heard they're hoarding toilet paper.
Toilet paper, so we learned.
Wait, toilet paper, though?
Yeah.
That's the one that you're going to stock up on ahead of tariffs?
But also what's interesting, too, we saw it in the UMich as well. I was talking to Joanne Shu, who leads the UMich data on radio earlier, and she was saying that people are buying durable goods now because they're worried about higher prices later. I mean, she didn't make the line for tariffs, but one can draw a conclusion, and that the expectation for inflation is also higher because of that.
That's certainly what a lot of manufacturers are pushing, too. I mean, they're out there kind of marketing this idea, like, get it now before prices go up next year, because you never know.
Have I told you guys about the driverless car that I took in San Francisco a few weeks ago?
There's a segue here, right?
Yeah, this is the segue. I'm just changing the subject. I took a Waymo, and I don't know if I'm surprised I haven't told you because I'm just talking to everyone about it. It was awesome. I took it at night in the rain.
Yeah.
Totally cool. I recommend everybody try this stuff.
Wait, you were going from point A to point B, or this was kind of just like an experiment?
I went point A to point B. I downloaded the app and just did it.
Was it cheap?
Yeah, it was $29. It was like the same price that an Uber would cost to do it.
I'll take it.
I didn't know this, but our own Ellen Hewitt, who we're going to be speaking to a little later today, apparently in San Francisco, some folks are attacking these self-driving cars. They've been smashed. They've been lit on fire.
They're getting lots of hate.
Well, they are like a symbol of the apocalypse, right?
I guess. They're so kind, though. You get in and the music's playing. They're clean.
Did you give it 5 stars?
I did give it 5 stars. There is a rating system, too. It's just like Uber or Lyft.
Is it like talk to you? How can it be kind? I don't get it.
It's a very welcoming environment.
Okay.
But there's no one to welcome you.
No, there's not, but your initials are on the top of the car.
So that makes you feel welcome.
Made me feel welcome.
Well, you know,
nice.
I'm going to segue to something else because Tokyo, the city of Tokyo, the government of Tokyo is trying to make female employees there feel more welcome. They're introducing a 4-day work week to help boost fertility rates and support working women, knowing that, you know, having to balance work and parenthood is very difficult for a lot of people, and they really need to get their fertility rate up. It's at a record low of 1.2, which is far below the replacement rate needed globally of about 2.1.
And this is all because people are working too much?
This is because people aren't having enough kids to support the pensioners.
Well, I get that. I mean,
need to get
and I guess we're trying to be delicate about this, but the point is it because they're at the office too much, or?
But then the idea is like if you're a woman that doesn't have kids and is not married, do you not get the 4-day work week?
Good question.
I don't understand how they implement this without
a weird line.
Or working dads will get a 4-day work week, for instance, and then they can help out at home, and then maybe the mom can go back to the office and work as well, and maybe feel more comfortable having kids.
I do think it's interesting too when they talk about kind of the salary concessions they're giving as well. So maybe you get a shorter work day, though you still come in, you know, for the 5 days. So I guess look, at the end of the day, it looks like it's just kind of flexibility, right? So if you want to have a family or you're planning for a family, maybe you have the flexibility to work that out.
I think the hard part about a policy like this is it takes so many years to understand if it actually works.
Yeah, absolutely.
So, yeah, we'll see.
Well, there's one way to know if it works, Tim.
Try it.
Go ahead.
And that's whether you end up with a baby in 9 months.
Jeez.
Guess I got to go. That is going to do it for our cross.
What? I mean,
coverage.
Come on.
He's cutting straight to the chase.
Somebody had to say it. You guys are too diplomatic.
All right, Tim, take us out.
Tim.
Come on now.
Bye, Nora.
Guys, have a great weekend. We'll see you same time, same place on a Monday. Enjoy a couple days off.
And we continue our coverage right here on Bloomberg Television. A closer look here at investors looking to diversify their portfolio, but they might not be seeing an opportunity that's actually hiding in the bottom of a bottle of whiskey. We're going to talk about how investing in casks of liquor is rising in popularity. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Stocks back to their winning ways here on this Friday afternoon. A record high for the S&P 500. 3 straight weeks of gains now for the benchmark index. The gains on the day may not look like much. Even on the week, we're talking about 0.9% here. But we should point out that the rally that we saw this week was not the broad-based rally that we saw in the weeks prior. You take the Magnificent Seven, 1.7% gain on the week, on the day, even more on the week. But if you strip out the Mag 7, heck, if you just strip out the Fab 5, the S&P 500 would be deep into the red. Your yield picture is basically where it's been for quite some time. Your crypto picture is where it's been for the last 48 hours. As we head into next week, more economic data, more earnings. It'll be interesting to see how the market moves.
Yeah, but in the meantime, you have some of those Mag 7 names gaining, and it is record highs for Meta as well as Palantir. Not a Mag 7 name, but certainly one of the AI names people are excited about. Meta Platforms getting 2.4% on the day after a court upheld a law that could lead to TikTok getting banned within the U.S. fairly quickly. So we saw Meta climb in a knee-jerk reaction. Snap also gaining ground as well. Palantir up 6%, rallying to a record after it announced a partnership with Booz Allen Hamilton, a fellow government contractor. On the downside, Qualcomm and Qorvo are lower. Bloomberg has learned that Apple is finally ready to start rolling out its in-house modem chips that would replace products made by Qualcomm. And it's all part of a bigger effort by Apple to bring its supply chain and manufacturing back in-house and make its supply chain more resilient. Qorvo is another company that supplies Apple's, and its products may also be vulnerable to Apple's modem efforts. Romaine?
All right, well, we have to talk about an interesting story because just yesterday, Bloomberg published this whole story about a $105 trillion inheritance windfall that it's on its way. And today, someone wrote a column about how wealthy baby boomers are willing to make their heirs wait for that money. That's at least according to a new Charles Schwab survey out there, which found that boomers are less likely to want to pass down their wealth during their lifetime compared to Gen X and millennials. Joining us right now is Bloomberg's Suzanne Woolley, who covers personal finance and investing for us. I both chuckled and cried a little bit at this story. I guess I don't really understand what's happening here. You have this money. You know, at some point you're going to pass away. You think you would sort of make some sort of accommodations to make sure that your children, grandchildren, whoever, got a little bit of piece of that pie while you were still alive. But I'm told this isn't going to happen, Suzanne. You're shaking your head, no?
The boomers seem to want to keep a close, keep their money close. I think a lot of boomers, it seems kind of stingy, but in a way, maybe it's thoughtfulness. I mean, I would think you would want to sort of see your heirs enjoy the money while you're alive. But I think a lot of boomers are worried about healthcare costs, and they're worried about being a burden on their family later in life. So it gives them peace of mind to sort of hold on to that money.
Yeah.
Or maybe younger boomers are in that sandwich generation where they're helping their adult kids and also their parents. So they're really not sure of what the costs will be. Or, maybe boomers are just like, I want it all for myself. I want to go out and travel.
Well, boomers have a lot of this wealth, but not all of it is liquid. I mean, a lot of it is in hard assets as well. What do we know about how their assets are distributed?
Well, they're overall, the wealthy Americans that Schwab surveyed, which were people that had over $1 million in investable assets, excluding their home and their retirement accounts, they were saying they wanted, on average, to distribute about 40% of their wealth over their lifetime. I think the average value would be $4.1 million, but 40% of that was in real estate. 31% was expected to be in investable assets, about 18% in cash, about 11% in life insurance proceeds. Mm-hmm. So a lot of it is in real estate.
Well, one thing that's interesting about that really kind of caught my eye about this also is the idea that, estate planning, there are some serious advantages by doing this before you pass away. The idea is that if you can sort of transfer some of those assets or at least get those wheels in motion while you're still alive, the tax burden on your heirs, in theory, should be less. I mean, at least that's how I learned it when I was taking my economics classes, when I was studying for the CFA. I don't know, has the world changed or something? Have the rules changed?
No, I mean, I think that still holds. It makes a lot of sense to pass along some of your money when you're alive and to sort of lessen your taxable estate, although the estate tax exemption is so high now at, 11.2 million. Most people don't have to worry about that too much. But it does make a lot of sense to do estate planning that passes along some of your wealth along the way and not just all upon your death. But I suspect a lot of it is emotional.
Sure.
It just feels comfortable to have that money, and it gives peace of mind. And peace of mind is really big, especially as people are getting older and worrying more about health care and what's going to happen with Social Security and Medicare, things like that.
Yeah, it speaks to the sense of uncertainty that people feel, even those who are older in their age, given what they're confronted by. Suzanne, really appreciate your joining us. Suzanne Woolley of Bloomberg News, covering personal finance and investing. And Romaine, we had a chart up there earlier that showed how millennials will surpass Gen X as the biggest inheritors in 2039. As you and I are both members of Gen X, it was kind of sad to see the Gen X curve just go,
Yeah, I've just given up. I don't even talk to my parents about this stuff. I just assume they're just going to, go with it.
With it, and you'll make your own way.
Yeah, self-sufficiency. That's what they taught us. Correct. Gen X, we are the bedrock. So
when they remember us.
Yeah, when they remember us. All right. Well, we all actually still want to talk about budgets. In fact, when we come back, we're going to talk about the federal budget. We're going to take a look back at history, a look back to 39 years ago, and the roots of the budget deficit battles that we're having right now, and that landmark Graham-Rudman compromise that imposed the first ever binding spending constraints on the federal budget. This is Bloomberg. All right, for today's look back in history, I really want you to think about the never-ending U.S. government budget battles, the string of federal shutdowns and near shutdowns, the downgrading of the Treasury's AAA rating back in 2011, all of that. The roots of that drama can be traced back to a major change in the law that began to unfold in the waning hours of December 6, 1985. That was when congressional negotiators reached an agreement on legislation that would ultimately mandate the government balance its budget within 8 years and abide by annual deficit ceilings that, if violated, would trigger automatic cuts to discretionary spending, called sequestration. The resulting law, commonly referred to as Graham-Rudman-Hollings, and widely derided as an automatic Pac-Man that would gobble up the budget indiscriminately. It was on the surface a sincere effort to halt and to remedy decades of bad budget decisions. But with 39 years of hindsight, we now know Graham-Rudman never achieved its promise. The deficit, which simply is the money the government collects minus the money it spends, that was a then record $172 billion. Today, it's a staggering $1.8 trillion. To pay for that widening gap, the Treasury has to borrow money by selling securities. As a result, the national debt, which is just the accumulation of that borrowing and the interest accumulating on those securities, that has now surpassed $35 trillion, 19 times the debt load we had back in 1986. So what went wrong? Well, Gramm-Rudman had several fatal flaws, including exemptions for entitlement programs and loopholes where Congress could technically breach that deficit ceiling without actually triggering those mandatory cuts. Congress tried a second round of Gramm-Rudman deficit controls to address those loopholes, but unfortunately, the results were the same. More legislation followed with the same goal and the same lack of results. But in 1993, newly elected President Bill Clinton did manage to push through a separate deficit reduction plan that did indeed appear to do the trick. By the late 1990s, the U.S. actually posted its first back-to-back budget surpluses in more than 40 years. But like most good things in Washington, that opportunity was squandered, and squandered quickly. The bursting of the dot-com bubble, a recession, and wars in Iraq and Afghanistan would flip those surpluses back to deficits, and this country and its finances have never been the same since. A deficit now, it fathoms, some say can't be ignored, representing roughly 6% of GDP. And the total national debt as a percent of GDP, that's tripled from 40% in the mid-'80s to 120% at the end of calendar year 2023. Scarlett?
Yeah, those are some big numbers, and it's something that, of course, we expect to focus on, the budget deficit and the national debt in the coming weeks, especially as Congress faces a December 20th deadline to avert a government shutdown. Greg Valliere is Chief U.S. Policy Strategist at AGF Investments. And Greg, I want to start here. Is there any real threat of a shutdown when you've got a bunch of lame duck people in Congress for about a month before a new session begins and the Republicans control the House, the Senate, and the executive branch?
No, I don't think there's much chance that that would happen. There'll be a lot of hot air. There'll be people who feel they can do something. I wouldn't be shocked if in certain budgets from various agencies get frozen. That's the most you can hope for, is to get frozen. And of course, there are other, as we just heard in that great summary, there are other things that just dwarf this relatively small amount of spending we have. Other things like Medicare, Medicaid, Social Security.
How safe, though, are some of those entitlement programs, Greg? I mean, that has been the third rail that no politician really wants to touch. But we've heard from Trump himself, as well as some of his surrogates, who said they're actually open to that idea.
They may say that, but I'd say good luck with that. I mean, that's the third rail, as you guys know. And if anyone tried to even mess around with the cost of living adjustment, the COLA provision, I think there would be a rebellion. People feel that this is money entitled to them. I think this would blow up in the Republicans' faces if they tried to really make any kind of serious cut in these programs.
And that's why they really haven't tried to do that before. But now you've got some people coming in from the outside. Elon Musk with the Department of Government Efficiency. I have a lot of relatives asking me, is Elon Musk going to cut Social Security? Is he going to cut Medicare? Because he's coming in from the outside and he's not beholden to voters in the same way that elected officials are.
Well, there are some things that will get considered. For example, the tariffs that Trump talks about incessantly could raise some revenues. He says they would raise enough to not need any more revenues. That's just doesn't make any sense mathematically. But there are things that can be cut. There are agencies that have a lot of fat that can be cut. So I don't totally dismiss it. But any kind of huge revolutionary spending cut would die in Congress.
Greg, I do want to pivot here and ask you a little bit about foreign policy. The president-elect is supposed to be in France over the weekend for the reopening, the official reopening of Notre Dame. But of course, everyone really wants to take a look at the interplay between him and, I guess, the now current president of France, Emmanuel Macron. When you talk about Trump's foreign policy chops, his relationships that he had with world leaders during his first term, is that going to be materially different in his second term?
It could be a little more sophisticated, a little more nuanced. He did see Trudeau a week and a half ago down in Mar-a-Lago, and they had a very constructive 3-hour meeting. So I think Trump may be a little bit more sophisticated. The thing that he needs is a victory. And, you know, maybe we'll see something out of Elon Musk that could look like a victory on a program or two. But what I think Trump really needs is something geopolitically, and that would be Ukraine. I think that we could be in an environment by mid to late winter where there's actually constructive talks on Ukraine.
Yeah, it'll be interesting to see. Of course, a lot of his surrogates are already trying to negotiate something, at least based on the reporting that we have. Greg, we have to leave it there. Always wonderful insights. We're going to catch up with you soon again, I'm sure. Greg Valliere there, Chief U.S. Policy Strategist at AGF Investments. And you do kind of wonder which sort of foreign policy Trump is going to sort of attack first, whether it is going to be the issue in Ukraine, obviously what's going on in the Middle East, and then you have all the issues with our relationships with Europe and China. Right.
Or will he continue to, make fancy trips to places like France and, talk up his relationships with France's Emmanuel Macron and his daughter's father-in-law, Charles Kushner,
well, I tell you what,
ambassador.
Yeah, well, I tell you what, Scarlett, I'm making a fancy trip to a nice restaurant later tonight. So let's talk Opentable and get some insights out of their CEO, Debby Soo. That's coming up next on Bloomberg.
The pockets of areas that are Republican dominated are thriving, and those that are not are having a harder time. We've even seen in our own restaurants that are in a more conservative area have definitely seen an increase in business post-election.
And that was part of my conversation with restaurateur Carolyn Stein. She is co-founder of the Loop Group. And Romaine, it goes to the idea that the restaurant industry is very sensitive to consumer sentiment. Perceptions of higher inflation or an unstable economy lead immediately to a pullback in eating out. But that doesn't happen across the board, across the nation, depending on how confident you feel about things like your political leadership.
Yeah, it's all about perceptions here. And we talk about restaurants. And I mean, you have to kind of just point out the obvious, which is probably one of the more ultimate of the discretionary spends for most people here. You don't have to eat out. We choose to. We like whether it's the food or just meeting up with our friends and family to do that. Yep. But again, how you feel about your own personal situation and the broader economy is going to be a big determinant of whether you're willing to actually go out and spend that money. Let's get some insights out of somebody who knows this industry better than anyone. Debby Soo, she's the CEO of Opentable, of course, the restaurant reservation booking platform. Debby, and I do want to start off with the idea of optimism. I was kind of regaling my co-anchors a little bit earlier about all my fabulous plans this weekend. They weren't as enthralled about it as I was. But, I feel good. And we're going to go out tonight. We're going to go out tomorrow. We got another dinner on Sunday. And it's great. But as we kind of heard from Caroline Stein, it depends on where you live, how you view the economy, how you view the world, and whether you're going to actually feel comfortable doing that. I know you track this kind of optimism data, don't you?
We do track it, and we track it across all of the cities that we operate in. And I'd say on the whole, especially because it's the holidays, and we've consistently see holiday dining, whether that be Valentine's Day, Mother's Day, Thanksgiving, and then, the remaining holidays of this year, demand is coming in really strong. And we're seeing that across mostly all of our markets here in the U.S. and even abroad. Up 8, 9, 10% year over year. So we're expecting a really strong holiday season, regardless of how you're feeling about the economy, your optimism on what's going on in the world. When it's the holiday time, people are showing that they want to go out, they want to be in restaurants.
Is there any sense, do you have a sense of kind of where people are spending their money? I mean, I know most of the restaurants that you have on Opentable, they're kind of more high end. I know you have some that are maybe a little bit more middle of the road here. But are you seeing any sort of selectivity in terms of what types of restaurants people are selecting?
We're not seeing a downgrade, if you can call it that, in terms of going to a different type or less inexpensive restaurant. The booking activity we're seeing is consistent, right? If you're looking for a 3-4 star restaurant, you're going to go out and do that. Where we are seeing this year a decline is how much you end up spending at that restaurant. So you might be still going to a nice, expensive restaurant, but you may not be ordering 3 drinks, right? You might be doing 2. So we're seeing check sizes be impacted this year. But during a recent Opentable survey respondents said that for the holidays this year, they are planning on splurging, they're planning on spending more, and we hope to see that because, of course, that helps our restaurants.
Absolutely. One thing that you've noticed as well is that people are starting to dine out, not just on the weekends or on Thursday, but on Wednesday as well. Can you explain that?
Yeah, so we're calling Wednesday the new Friday. And we're seeing activity and reservations happening on Wednesday, almost double digits year over year. And I think there are a couple of reasons at play here. With the rise of remote or hybrid work, often people are not going into the office on Mondays or Fridays, but they are going in on Wednesdays. So after work, you can grab drinks with a coworker or a group of your friends, things that you would normally pre-pandemic days do on a Friday. Often people are doing on a Wednesday. And when we ask people, they say, Wednesday, because we can break up the week.
You can break up the week. It just gives you something to look forward to. And I guess with the advent of hybrid work and people having more flexible schedules, that idea of eating starting at around 7 p.m. may be no longer what needs to happen. I'm guessing that people are starting to make reservations for earlier in the evenings as well. And sometimes maybe just dining out on their own, too.
Yes, so we're seeing on the time front, back in the day before COVID, 7 o'clock was that very coveted dinner spot, and it continues to be a very popular time. But what we're also seeing, even in cities like New York City, 5:30, 5 o'clock, 6 in the front, and then at the end, people are now booking towards later in the night, 9:30, 10 o'clock. And as you mentioned, solo dining continues to be going strong. People are very confident and feeling good about going out to a restaurant by themselves. And we're also seeing group dining increase. So groups of more than 6 people are on the increase as well.
So quickly, if people are making reservations at 5 p.m., does that allow the restaurant to add in more seatings? They can get 3 seatings in as opposed to 2.
It depends on the restaurant and how long, but yes, certainly if you can start earlier, you might be able to get a third turn in versus the 2.
I am curious, Debbie, though, about when you're dealing with your restaurant customers, meaning the actual restaurants themselves, the owners. How are they feeling right now? Because we talked a lot about coming out of the pandemic and how a lot of restaurants really sort of had to find a way to get their footing for this new world order, whether it's how people dined or the amount of money they spent, and obviously things like labor and supply chain costs. Are you seeing more optimism from them, from the ownership side?
It varies really across each market and what restaurant you're talking to. But generally, I would say people are feeling very optimistic about this holiday season. There were times this year, for example, summertime in some big cities like New York, that were slower than we thought it would be. And so restaurateurs definitely felt that. But the holidays, starting from Thanksgiving all the way through, Christmas and New Year's, are generally very strong times for dining demand. And we're all feeling very optimistic. We're starting to see the reservations come in, that will be the case. And oftentimes for a lot of restaurants, this is the period where they make their margin for the year.
Yeah, absolutely. And what about like new restaurants, like the creation of new restaurants? I was looking at some data for New York City, which obviously has a tremendous amount of churn in restaurants for a variety of reasons. And the new creation. Newly created restaurants, that number was down pretty significantly from prior years. So you're just not seeing as many new entrants come into the place. And I know that's just one city, but I am curious as to whether you're seeing anything nationwide that might be reflective of that.
I think you're right that the trend you're seeing in New York is the trend that we're seeing across the country. However, we are still seeing a lot of new entrants, right? The chefs have these genealogy trees. So if you worked at one restaurant, then you come out and open your own. That type of activity, I think, is still very much happening. People who have been in the industry for a long time and coming out and trying their own hand at it. We love that, and we really love supporting chefs who are new and up and coming. Many of them are part of our Icons and Visa Dining collection. So new, hot, buzzy openings in cities like New York City are definitely still happening and very, very exciting. But I do agree with you that on the whole, we're not seeing as many openings as we did pre-pandemic.
Well, there's a lot of costs and inflation concerns out there, whether it's the ingredient of food or of imported goods that might see tariffs, or even labor, especially if there's going to be a crackdown on illegal immigration, which, let's face it, does power a lot of the kitchens across many cities.
That's right. Labor is a huge issue for all of the restaurants we talk about or we talk to. They're constantly, right, the churn and the overturn of staff has been huge. The cost of that staff. That's when we talk to restaurateurs, and it doesn't matter what city, that's the first thing they talk about in terms of the challenges they're facing.
Yeah, it's the first thing that diners talk about, too, when they sit down and look at the menu as well. Debby, always appreciate your time. Debby Soo is CEO of Opentable, the restaurant reservation company. Romaine, you are a child of the 80s and 90s, so you know about Chi-Chi's. Some of our producers who were not around at the time don't know about this, but Chi-Chi's, the Mexican restaurant, disappeared about 2004, very popular in the early 90s.
Yeah.
It's making a comeback.
I was kind of intrigued by this and surprised by this as to why they would bring it back. I guess it is a brand name, and I guess it resonates for people of a certain age. But it also comes at a time where we're seeing so many closures of these sort of chain restaurants, these national chain restaurants that have struggled. We've seen a couple go into bankruptcy this year, major ones, TGIF, obviously the struggles with Red Lobster, and there are quite a few others that are, at least in terms of their finances, certainly seem to be on the edge. So the fact that this one could kind of be resurrected, and maybe that IP is valuable enough where they could turn it into the next, I don't know, Chili's. What do we compare it to?
Well, maybe, for a younger generation, it's like, oh, there's Chipotle, and like now there's a play on Chipotle, Chi-Chi's, even though Chi-Chi's predated Chipotle.
So you're saying that basically just need to make it like kitschy and, And
I mean, if you can play off of the popularity of Chipotle, then like maybe there's a place in the marketplace for you.
Yeah, it'd be interesting. Chi-Chi's. I just want to point out that when we saw the story this morning, I think half the people in this newsroom had never heard of it.
Right, or they called it Chai-Chais, which, I get
Which also means they never heard of
it. All right, let's just give you a recap of what happened in trading today. We know the S&P 500 closed out a third straight week of gains. That is a record high. What number is it, record high?
57.
57th record high of 2024. The S&P closing at 60.90. And it wasn't just stocks. Bonds also gained modestly following what some people are describing as a Goldilocks jobs report that keeps hope alive for a December rate cut.
When does Bitcoin split? Do they do stock splits on Bitcoin?
No, they don't do that. They have a halving thing, but that's separate from the stock split. Yeah.
I never understood the halving.
I know. I feel like it's
Everyone always tells me the halving is going to be a big thing, and it's never a big thing.
It's a big thing for those who are in the know.
Okay.
Well, you're not in the know, nor am I.
2% on Bitcoin, over 100,000. How do you like them apples?
That's not even a gain for Bitcoin, really.
Yeah, I'll take it. This is The Close on Bloomberg.
For Next Up, where we highlight the entrepreneurs and trendsetters moving the needle in the markets, technology, and venture capital space. Investors often stress the need to diversify their portfolios, maybe include some hard physical assets like maybe whiskey. CaskX, this is a company, makes it possible for everyone to invest in bourbon barrels and Scotch whiskey casks from leading distilleries. How does this work? Joining us now to explain is Jeremy Kastler. He is founder and CEO of CaskX. So, Jeremy, are we talking about investing in the barrels, the physical barrels, or the whiskey inside, or both?
Well, both. So you invest into a new fill barrel of bourbon, which is a barrel that's been newly filled, as the name suggests. And then the barrel gets put into a rick house or a storage facility for up to 8 years, and as it ages, the flavor profile changes and it increases in value, and then at some point we hope to sell the barrels and make some money.
And how many barrels does one buy? Do you buy one barrel at a time, 100 barrels at a time?
Well, we would go out normally to a distillery and we would source maybe, say, 2,000 barrels, and then we would sell them in smaller quantities of 50 or 100. So most of our clients come in around the, say, the 50 to 70 barrel mark, something like that.
For those folks who come into this investment, Jeremy, I mean, is there like a lockup period where, basically they have to go to stay invested in this? What's the general structure of it?
Well, legally, they have to hold the barrels for at least 1 year. That's the SEC guidelines, because this is considered a security for SEC purposes. In order to make money, you would need to hold the barrels for at least 4 years. But we would ask our clients to expect to hold for up to 8 years. So generally speaking, anywhere from 4 to 8 years would be the premium spot.
Of course, there are a lot of people that will invest in this simply because they like whiskey or like the concept. But at the end of the day, a lot of investors, as you know, Jeremy, just want to know what the return's going to be. What type of returns do you? I know you can't make promises for returns, but what type of returns do you think could be typical on a year-to-year basis?
Well, we've seen historically somewhere between sort of 12 and 14% per annum, something like that. There is, a real bourbon boom at the moment. There's more bourbon being sold in the US, but more importantly, internationally, there's a massive demand, and the supply isn't quite meeting demand, so the prices are going up exponentially.
How do you source your distilleries? I mean, if there's a bourbon boom, that means a lot more people are going to get into it, and that means a lot more supply coming onto market too.
Yeah, well, we have our due diligence. We look at different distilleries. We build relationships over a number of years, because if we look at, say, 20 distilleries, we might recommend one. So once we've recommended that distillery, again, we build a relationship and we try and buy as much as we can, which isn't always easy. And whatever we can get, we can sell on to our clients.
So give us a sense of the size of the investor base for CaskX. What did you start with? Where is it now? What's the growth rate here?
Well, as a company, CaskX started in the US 4 years ago. We were formed initially in Australia, then we opened in Hong Kong. Year one, we did around about 5 million in revenue. Year two, 10 million. Year three, 20 million. And this year, we're looking at somewhere close to 30 million in revenue.
Wow, and I am curious, though, too, and it gets to something that you just said a little bit earlier, and also to Scarlett's previous question, too. When we talk about the boom, and more importantly, the export opportunities, earlier this week, there was a lot of concern coming out of Brown-Forman, of course, a behemoth liquor maker, about tit-for-tat tariffs under the Trump administration and whether that would affect its ability to export some of its American whiskey to places like Europe. I assume you have to have this on your radar, and if so, how much of a factor will it be in how you model your financials going forward?
Well, tariffs come and go. So, previously there were tariffs in Europe, and when the tariffs came into place, the American whiskey market started focusing on different markets. Then the European tariffs were taken away. So it's something that's cyclical. The 1 minute there's tariffs, then there isn't. So at the end of the day, the international demand is absolutely huge. There's more people drinking whiskey in India, in China. All these new markets are now coming into play. So it's not necessarily just about the US market. There's 8 billion people who are potential clients overseas, as opposed to 350 million here.
Have you thought at all about diversifying CaskX? And I ask that because while a lot of us love whiskey, myself included, as you know, tastes can change on a whim, and all of a sudden everyone starts drinking vodka or, for some strange reason, tequila, and these things kind of come and go, and so all of a sudden whiskey falls out of favor. Are you prepared to deal with that, or do you sort of have a plan in place to continue that growth, specifically in the bourbon and whiskey market?
Yeah, well, it's hard to plan for changing tastes, of course, but getting back to the international demand, that India historically has been the world's biggest market for drinkers of spirits. So as those markets expand, it's kind of irrelevant whether tastes change, a little bit here or there. So, we're quite confident the boom is current. It will continue. If you go to Kentucky or Tennessee, all you see is distilleries being built and rick houses being put in place. So we're very confident, very bullish about the market.
All right, Jeremy, great stuff, and really interesting concept here. Jeremy Kasper there is the founder and CEO of the company CaskX, part of our Next Up segment here. You can invest in this, Scarlett. I don't know if you're a whiskey drinker or not, but you don't have to be, as long as you believe that other people are.
I know, but what would I give up? Do I not invest in wine because of this? I mean, like, if I have an alternative asset, which one do I pick?
I don't know. I mean, it's either this or Bitcoin. I don't know. What else is out there?
Bitcoin, $100,000? Anyway, let's go now to the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Paul Krugman, the Nobel Prize economist, retiring as a columnist for the New York Times after 25 years. He's going to write his final column before the end of the year. And And what's fascinating is that during his time as a columnist, he has taken readers through the Bush era, Obama era, Trump era, Biden era, and leaving before Trump too.
Yeah, I mean, he's obviously one of the great minds in economics, and of course, he won the Nobel Prize, a couple decades ago, back in 2008. I read his columns. I mean, it was a must-read. Yeah. And he, as you know, he was not afraid to sort of poke the bear, so to speak.
Ruffle feathers.
Whoever was in power. That earned him a lot of enemies, but it earned him a lot of fans as well. Which point out, he is 71. He's been doing this a long time. Maybe he just kind of wants to move on.
Yeah, go on vacation, Paul.
Out there. All right, somebody who's not moving on is a guy named Brian Hill. You may not know his name, but you certainly know his company, Aritzia. It's a big Canadian retailer, and it's been building a big presence here in the U.S. He now has a net worth of over $1 billion following that expansion into the U.S. They now have roughly, I think, about 22 stores in the U.S. They've been primarily Canadian-based. What I thought was interesting about this was I only knew this company from the few times I went to Canada when I was younger, and I didn't know it was kind of moving into the U.S., but apparently this is blown up on social media.
It's
so you
everywhere
got, like,
now.
Bella Hadid and all these big stars are posting stuff on social media, wearing the clothes, and that's been a big impetus for their growth here in the U.S.
Absolutely, and what they've done is aggressively open stores in the U.S. They have a lot of prime locations, and these are leases.
They got one somewhere downtown in New York.
Yeah, they have one opening up on Fifth Avenue soon, too. They signed their leases towards the end of the COVID era.
That's what I was talking about, Scarlett. They got one in Chicago, too, by the way, if you ever get there.
No, very popular. Very popular. But they took advantage of when leases were low and leases were low. Rents were low, and they signed their long-term leases.
Do you own any items?
I do. I have a pair of pants I wear for work sometimes,
I've never bought anything from them. I'm going to go check them out this week.
You should. I don't know if they have men's clothing, though.
Oh, well, maybe I won't check them out.
All right, let's round out the top three with Taylor Swift. The singer is set to conclude her 2-year-long Eras tour this weekend in Vancouver. Some last-minute tickets still available online, $500 each.
Yeah, this is the end of an era, Scarlet Fu, pun intended.
Yep.
Look, this was a juggernaut. We talk about the first tour for an artist, single artist, to gross over $1 billion, and maybe more than that, depending on what happens over the next 3 days in Vancouver. What's next for her? Scarlet
She could do anything.
You're a Swiftie, right?
I'm not really a Swiftie, but she did appear on my Spotify
You're a
list.
Kelsey. Or whatever.
No.
I don't know how you pronounce it.
I don't like him either.
All right.
But, I just love the fact that she's been a boon for the local economy no matter where she went.
Yeah, it was always kind of funny seeing that. And I was actually just in Vancouver on assignment, and that was all anybody was talking about. Well, and that was like 2 weeks ago. And everyone was just talking about
the lead
up here. Yeah. They were already making plans for that. So obviously, an economic force in and of herself. Be interesting to see what her next move is for 2025. Meanwhile, we're going to set you up for what's happening over the next 5 trading days with what to watch. That's coming up next, right here on Bloomberg. As we wrap up this week, we look ahead to next week and what could potentially move the market. On Monday, we do get some inflation data out of China, and Euro finance ministers are meeting. You're going to be watching them, Scarlett?
Well, Trump is going to be in Paris, so I guess we're all going to be watching it.
A lot of people are going to be watching that. We do get earnings out of Oracle as well as MongoDB that day. The next day, we get additional earnings out of names like AutoZone, Dave & Buster's, and GameStop. Remember them?
Yeah, but there's not much to say about revenue at GameStop. We also have a RBA rate decision on Tuesday.
And then we go to Wednesday. Back here in the U.S., we do get that monthly CPI report, consumer inflation, Scarlett.
And that's going to be critical to whether the Fed does indeed cut rates the following week, because the jobs report kind of came in the way that everyone says sets us up for CPI really mattering.
Yeah, that report coming 1 week away from the big Fed rate decision. But then on Thursday, December 12th, we do get a decision out of the European Central Bank.
And they're expected to cut interest rates. That's been kind of the consistent theme there. We also get another read on inflation in the U.S., wholesale inflation with PPI.
Look for earnings out of Costco as well as Broadcom. And on Friday, we get some data on the import price index. As always, we thank you for tuning in to us this week. We'll be back next week right here on The Close, right here on Bloomberg.